Brad Williams, Frugal Finance, the behavior of bond pricing over time. In this section, we examine how bond prices change over time as a result of the passage of time and changes in interest rates. This is going to separate those that want to get into fixed income and those that go, well, I like stock market, so you fixed income folks knock yourself out. I'll learn the basics here, but I'm not going to deal with this complexity, and it's going to get very complex. So with that being said, the effect of passage of time, if the yield curve were flat and interest rates did not change, any default-free discount bonds would rise with the passage of time, and any premium bonds would fall. This is because all bonds must eventually mature, and at maturity, their price must equal their face value. We would expect the price of discount bonds and premium bonds to move towards their face value as they approach maturity. This implied price pattern is illustrated for the case of a 20-year pure discount bond as shown below. Let us illustrate the calculation assuming the face value is $1,000 with a 6% yield and a 20-year maturity. Note that the price at year 20 and the coupon and how both change year by year. We have this price 20-year to maturity, $311.80, price $19.30. What am I talking about here? Equals D27. You can see the pricing here at year 20. We have this present value. All we did was take 1.106 to the 26. All we're doing is looking at this year, and here's the price. Why? Well, because we have 21 years. Price, if bond matures at year, we have this $311.80. Coupon 6%, and then proportional change just doesn't mean anything. You can see every year that we're going to have this price change, 1871, and so on and so forth, 330, 350, and then all the way at maturity, it changes to $1,000. Why? Well, you have to determine the present value. Flip this around, and you know what's a dollar worth in 21 years. If this was $1,000, your $1,000 in 21 years, it's only worth $311 today. But if you earn 6% interest on it, it's going to increase in value. This is just reversed. So notice that. You can see, theoretically, let's say there's $1,000 up here in this little pot that you just put into this pool. That $1,000 is discounted now at $311.80. At maturity, you're going to get that $1,000 back. And then over that time, you're earning whatever that interest rate is, which was 6%. Normally, we think of buying U.S. Treasury bonds as a conservative investment policy because there's literally no risk of default. Believe it or not, 5 years ago, the U.S., and again, these are not exact numbers, I'm going pre-COVID, U.S. debt was something to the tune of $13 trillion, which was just egregious. It's out of hand, all right? Then there were policy changes. But now, 5 years later, that $16 trillion is up to $31 trillion. It's almost doubled in 5 years. However, an economic environment of changing interest rates can produce big gains or losses for investors in long-term bonds. Here's a yield curve. This is inverted. This is how it is today. Just for an example, these are interest rates right here. Here is time. Usually it goes like this. Here we have this inversion. Why? I asked this question earlier, so I'm going to pose it again. Why are interest rates like this? Figure 8.4 illustrates the sensitivity of long-term bond prices to interest rates. It shows the magnitude of the changes that will occur in the price of a 30-year pure discount bond and a 30-year 8% par bond if the level of interest rates move to a value different from 8% immediately after the bonds are purchased. Each curve in figure 8.4 corresponds to a different bond. Along the ordinate, we measure the ratio of the bond's price computed using the indicated interest rate to its price computed at a discount rate of 8%. So you can see, look at this change here. We have zeros up here, which are typically U.S. Treasuries. And then we have par bonds. Look at the variation. We go from 4% to 5%, and then 6%. You could see if you're holding zeros and prices move against you, you're going to see some serious price changes. Zeros versus par bonds. For example, at an interest rate of 8% per year, the price of a 30-year 8% coupon bond with a face value of $1,000 would be $1,000, while at an interest rate of 9% per year, its price is $897.26. That's par bond. The ratio of its price at a 9% interest rate to its price at 8% is therefore 897.26 divided by 1,000 equals 0.89726. We can therefore say that if the level of interest rates were to rise from 8 to 9%, the price of the par bond would fall by roughly 10%. That's a 1% move on pricing. That's pretty serious. The figure shows the magnitude of the change that will occur in the price of a 30-year pure discount bond, a 30-year 8% coupon par bond. If the level of interest rates move to a value different from 8% immediately after the bonds are purchased, the ordinate measures the ratio of the bond's price computed at the indicated interest rate to its price computed at a discount rate of 8%. So at an interest rate of 8%, the price of the pure discount bond would fall by roughly 23%. Ouch. You can see why in the fixed income arena, they're broken down into 30 seconds. Full point move could be devastating. That's why there's a lot of tools out there, hedging tools, that will protect investors. But nonetheless, if you're going to play this fixed income game, volatility. And we'll get into that later. But for now, just an introduction as to what this curve is all about. Note in figure 8.4 that the curve corresponds to the pure discount bond steeper than the par bond's curve. This greater steepness reflects its greater interest rate sensitivity. And that's the key word when you're doing fixed income, sensitivity. Lots to come. Brad Williams, Frugal Finance. Thanks for watching.